Hey everyone, my name is Ryan and I am a mortgage lender. I have been a mortgage lender since 1999 here in Utah. I live in southern Utah, but I do lending in the states of Utah, Nevada, and Florida. That's where I'm licensed. And there's a lot of guys on my team and guys and girls on my team that can help in almost every single state. There's a few states where we have some limitations on, but I'd love to answer any questions you have about mortgage, about credit, about real estate. So that's kind of what this show. I go live every once in a while just to answer questions about this whole process of getting a home loan, the process of helping you with your credit reports, or the whole idea of real estate in general. If you go to my website at ryanbolton.com, you can fill out a form for me to reach out to you. There's no cost or obligation to review all the different financing options you might qualify for. Even if I can't help you, I can direct you to where somebody that can, or I can answer general questions just to help you with this process. ryanbolton.com. Also, I'm really proud of the mortgage calculator that I have on there because it's totally free. There's no login, sign in, there's no paywalls, there's no capture your email or phone number or any of that kind of stuff. It's just a free calculator. And what I really like about it is it gets into what your total payment's going to be with taxes, insurance, HOA, the other things, not just the mortgage. And it will help you calculate things like mortgage insurance on an FHA loan, or the funding fee on VA, or the USDA fee, or just conventional interest rates along with mortgage insurance. You can add the HOA. So you'll just get a more complete idea of what your payment's going to be. And again, it's totally free. So check out my mortgage calculator on ryanbolton.com. You can also download the mobile app if you want to get pre-approved, or if you just want me to follow up on a scenario. There's a little sales funnel that's there. You can kind of click through just what you're looking for: a refi, a purchase, home equity line of credit. And again, it's all free. There's no cost or obligation. We don't automatically pull your credit, none of those particular things. So thought it'd be kind of fun. If you have any comments, questions, you can submit that in the chat. I'm using a system called StreamYard on Facebook and YouTube. So it should be able to populate those questions so I can see it here. So if you do have a question, go ahead and post it there. Otherwise, I found a couple that I thought were pretty interesting online, some of the questions that are floating around out there. And so I just want to answer some of those until some comments pop up. So let me just pull up that list really quick. First, I want to make sure that I got my StreamYard thing here sitting here so I can see any comments that come in. And again, thanks for joining. All right, the first one I saw here that I thought was actually pretty interesting and a common question I see on reverse mortgages, and that is, what happens if you outlive your reverse mortgage? Here's the peace of mind with that particular program. You can't. You can live to 1,000 and you never have to move out of the house or leave the house. Now, the loan is still accruing interest, so the balance is still going up. Your equity is kind of making those payments for you, but you can't outlive it. That's one of the benefits of a reverse mortgage. Now, if you move out of it for any reason for more than 12 months, so assisted living, or if you move to another house or move in with another family member, there is some clauses that can call the note due. But in general, it is not something you can outlive. It doesn't have a term like a 30-year fixed mortgage. It doesn't work that way. You can't outlive it. Now, what happens if the balance is more than what you can sell the home for, or what the bank can sell the home for? That's one of the reasons this loan is more expensive, is the mortgage insurance is built in. So even if there's a chance that your equity can't make the payment anymore, for instance, it doesn't matter. That loan, there's no recourse on the loan, so you can't outlive it. Your equity can't be extinguished, and all of a sudden you have to move out. It really is designed to keep you in your home, or your elderly parents in their home, as long as possible without a monthly payment. The equity is essentially making the payment. The interest is added to the loan and it goes up. Now, the idea is the appreciation should also go up. They only loan less than 50% of what the home is worth. I mean, it's even been lower. It's been like in the 30s for a while now. It's starting to kind of come back depending on interest rates, but it's something where there's usually a lot of equity to make those payments. And so it really can be a good loan. There's benefits and disadvantages with every loan that's out there. So if you want to have a more of a thorough review of your situation, I can help you with that style. If you have parents, grandparents that are looking at this type of loan option, I'd love to help them. And let's review all the options, from traditional alternatives to reverse mortgage or a full-blown reverse mortgage. We can help with all those. But that's a common question or a common misconception, is what happens if you outlive the loan. You can't. It's not built that way. You could live to 1,000 and you won't outlive the mortgage. The next one I thought was kind of interesting, and this gets into uh, it's interesting of how you can answer this question because you don't have enough information to totally answer. But here's the question: it says, "What salary do you need to afford $1 million home?" Now, the debt ratio is the biggest factor when it comes to salary versus other debts. So, to afford $1 million home, you have to make a certain amount of money, but you also have to factor in other debts as well. So, here's typically what lenders want to see: they want to see that your total debts, your car loans, visas, student loans, and the new mortgage is typically under 45% of your income. So if you have no other debts, that does usually let you afford a little bit more home. Now they don't want to see the front end debt ratio, it's just the house itself, also at 45% typically. Now it depends on credit, down payment. There's other factors to offset that part of the risk. But mortgage financing is very much based on risk. And the more risky it is, either the more offset of down payment, credit scores, debt ratio, other things have to offset that risk. So I've seen times it goes clear up to 60% on debt ratios because it also a little depends on what money's left over. If you're making a very high amount of money and you've got a lot of maybe business, other rental properties, or we're not counting the income, but we see you have a lot of money left over, debt ratio is a little bit different in those cases. But generally, if you take all of your expenses plus the new house payment, generally we want it to be under 45% total. And they will go off of the gross amount, not the net. So we take whatever gross is. Now it's a little different with self-employed. With self-employed, we're going to take after your expenses, but certain expenses we can add back in. So that's part of my job, is to sit down with the client, figure out what loans they qualify for, which ones do they miss out on, what different rates and terms are going to be available, ways to strengthen the credit file or the income file or the tax return, whatever program we're trying to use to help you get into a home loan. But there's a lot of programs out there that are designed to help you with that. So what salary do you need to afford $1 million home? It's really going to come down to the other debts that you have to be able to determine that full number. If you have any questions, you should be able to post them in the comments there, and I'll be able to get to those. Any questions about credit, real estate, mortgage financing, I'd love to help you with that. Let's see what else we've got here. What time do mortgage funds get released? Oh, that's an interesting question. So when you buy a house, there's typically the signing process where you sign the paperwork for the loan itself. If you're paying cash, it's a little bit different. But if you're getting a loan, you'll sign the paperwork. Once that gets confirmed that the sellers have signed, you have signed, then they will send a wire to the title company. And depending on when that wire gets ordered, it's either same day or next day. Now, there's some states that are called wet or dry funding states. And what that means is when you send the loan package, you also have to wire the funds. But not every state is that way. So it depends on your state. More and more are starting to go with this wet fund idea, where basically as you're sending the loan documents, you're also sending the funds to close on that loan. But they'll still want to see everything signed, go through it, make sure there's nothing missed, make sure the seller has signed before they'll allow it to be recorded. And that's where all the money is distributed by the title company to the seller, to the commissions to agents, wherever that money is all allocated to go. County taxes for sale, for property taxes, or for transfer taxes or HOAs, all the different places this money can go. The insurance for the first year, the homeowner's insurance premium. So the title company gets all the money, your down payment, the wire for the mortgage loan, all that. They kind of collect all of it. They give you this breakdown of where every penny is going, and then they distribute that out once they're authorized to fund and record. So once they balance everything. So there's a little process afterwards. People think they sign, it's just done. There is a couple other steps, very much on the back end, that we're working with our funding teams, with the title company, to just make sure everything is final and done. But once it's recorded, then that's when it's your home. And that's when you typically will get keys, garage door openers, whatever else that you need to actually be the homeowner at that particular point. So it says, what time do mortgage funds get released? If the wire hits early enough, it'd be same day. And then some states, it's the next day, and usually business day. So I usually try to close on Wednesdays and Thursdays, just to make sure that we don't have that extra rush on Friday. and we just don't lose the weekend. So oftentimes I kind of train my agents or talk to the builders agents, just pull out a calendar, and before you just kind of pick the last day of the month, just double check it's on not a holiday or a weekend and not Fridays. I think that's just so much easier to schedule stuff Wednesdays and Thursdays to get the signing done, get wires done, get everything kind of settled, and not lose the weekend. I cannot tell you how many times there's been closings on Friday. They have to wait till Monday. And usually they're waiting till the next Friday, a whole nother week before they're really doing much with the house through the week. So I usually try to do that. Now, it doesn't always work that way. Sometimes there's delays. I mean, stuff happens in real estate like crazy, of course. But I generally at least try to be proactive when I'm doing the contracts to see what day that actually falls on. And I always try to do Wednesday, Thursdays. It just is amazing how much that'll give you a little buffer. And then they get keys by Friday. So you have kind of Friday, enjoy this new house, the weekend to kind of start messing around. Even if you're not fully moving that weekend, it's just nice to get the keys for a weekend and not kind of lose that weekend, if that makes sense. Again, you should be able to post comments. I'd love to help you with mortgage financing, ask any questions that you have about mortgage financing, credit, real estate. That's what I'm kind of here to do this live for. Should be on Facebook and YouTube, but I'd love to answer any questions you might have. Let's look for some more questions real quick. Can I get a home loan for construction on land owned by my mother? Yes, there is options for that. It will depend on who the builder is. That's usually a bigger concern. Is the builder, if it's owner builder, it gets a little bit trickier because it's more risky for the lender that you won't finish the home on time, that you don't have the contact with subcontractors, you're not a general contractor. So it depends on who the builder is going to be the bigger hang up than who actually owns the land. But here's what I would recommend looking into is to have your mom do what's called a subordination to the lien of the construction loan. So instead of having to pay her off kind of for the land, you can actually use that as kind of part of the equity or down payment that's required for the lender to be able to do the loan. Now, it might be an inheritance. Maybe there is no money involved. It's just she owns the land and he wants to be able to put a construction loan on it. It should be fine. There's some title work to get ownership, and there's some other things to do there. And there's some double checks that they will do. But the ownership of a family member isn't going to be probably the biggest hindrance on a construction loan as who's going to build it. And the other numbers, cost breakdown, builder docs, insurances, those types of things. So when you do a construction loan, there's kind of three things that get approved. The builder, you as the borrower, and the project. So they'll want to see if the house was done, what would it look like as far as elevation, square footage, what would it sell for if the home was done? So that's kind of the project itself, the type of construction, all of those things is the project. Next is the builder. If it's an owner builder or if it's just a normal general contractor, they'll want them to be approved. So they'll want to see they have E&O insurance, that they do have their licenses, maybe even some resume on some other builds they've done. They'll get maybe a list of subcontractors to call and say, hey, has he paid his bills on time? And, is a reputable builder, that type of thing. And then you as the borrower. So the more you can strengthen each one of those boxes, the more likely you'll get better terms and the construction loan itself. So the land is definitely part of it. It's part of the project, but who's selling it isn't as big of a factor as the other things. All right. Any questions in the comments? Let's check that real quick. If you have any questions, you can put them in there and I'll answer those for you. Oops. Let me go. Hopefully the microphone's working. I hope. I'm still new at how to do all this stuff, so I'm figuring it out. Let's see. How do you decide on whether to lock your interest rate or to float? So float is basically saying, okay, it's just going with the market. That's one of the terms that we use is locking. You're locking that day's pricing. So it's not necessarily locking the specific rate, even though that's what you typically do. So if it's say 6.5%, you're locking that rate, but you can go back to that day and adjust that rate based on that rate sheet. So it's kind of a misconception a little bit about what you're actually locking. You're locking that day's pricing whenever you submit that interest rate or that lock. So if there's for some reason you say, I want to look at maybe upping the rate a little bit to lower the costs, or maybe the other way around. Maybe you're seeing 6.5 and say, well, I want to actually buy it down. What are my options? So you don't have to go up to today to kind of relock it. You go back to that day's pricing and adjust it. Now, if rates are worse, then you don't have to worry about getting a worse rate, even if you adjust it. But if they're better, you're still with that interest rate as well. Once it's locked, you're kind of locking that day's pricing. Now, most lenders will allow what's called a float down. If the market makes a big difference, they'll let you kind of float the rate down to closer to what it was for that particular day. But it won't be on every single basis point of adjustment. There'll have to be enough of a swing where they will allow that float down. Because if the opposite happens, if rates get dramatically worse, they're not going to come back to you and say, well, we locked you at 6.5, rates have gone to 7. You're going to have to take that higher rate. So it is designed to be locking. And part of my job is to do the best job I can for my clients to kind of try to predict where the market's going. I've got tools open on my screen every single day, looking at the candlesticks, watching the trending, watching the commentaries. I get alerts on my phone to float or lock or something's happening, try to get ahead of the curve a little bit. But a lot of it is just educated guesses, just like trying to guess a stock price or oil prices or any of that type of stuff. They're going to have fluctuations. But I try to be excuse me, I try to do the best educated guess that I can, but a lot of times it is exactly that. It's an educated guess. Typically, a lock is good for 30 days. You can lock out for longer, but the more after 30, the more there's a little hit to the pricing to lock it longer. So generally, if it's within the 30 days, that's going to give you the better rates and terms. And that's the standard lock is going to be for a 30-day period. So hopefully that helps a little bit. But how to decide? It's really just education, experience, watching for trends, trying to catch certain things. And sometimes it's easier than other times. I mean, right now with this whole war thing going up and down, I mean, it's been a little bit of a moving target to say the least. The Fed's been kind of moving their target a little bit. There's different opinions on whether they should lower the rate. There's a big push to lower, and other people are saying no, no, no. So it's a lot of wait and see and just a lot of kind of writing it out. But I will tell you, everybody's complaining about these high interest rates when we're still below the 70-year average, even still below, I think, the 50-year average. We were just spoiled with rates under 4% for so long when typically mortgages are in the 6 to 7 range. They're 30-year fixed rate money. So they're locked out for that particular long. So really a 6.5% interest rate historically is fantastic. It really is. The downside is the homes aren't $300,000 anymore. I think our median home price here is up to $580,000. And I think the median around the country is a little less than that, but we're 500,000 now, and that interest rate is kind of compounding in, and just how quickly it went up. We kind of were at that normal rate, if you will, for under 4% in the threes for a long time. So to basically see that double in such a short period of time, that's been that way now for probably 3 years. That's been the adjustment that most people have had. But I keep seeing it all over the place. The new normal. This is but it's not even the new normal. It's back to the old new normal. If anything, again, it's still better than historic numbers, but it's still an adjustment with the price of the homes. And that's a constant battle that we're going to have. It's always been a constant battle of affordability. And there is more things trying to happen there with cheaper land prices, or what you're really seeing is density, where they're just getting more units out of each acre, which helps to offset and spread some of those initial costs out. One tip I'm seeing a lot of people do is for their first homes, I'm seeing more co-signers, brothers and sisters kind of teaming up, college roommates kind of teaming up on the first house, even father and son. I'm seeing that a little bit more often, which is at least letting people get into some home ownership. And we'll see how that kind of pans out over the next few years as people then try to either refinance out of that, or one sibling wants to sell or roommate wants to sell. It'll be an interesting thing how that plays out over the next little bit. But that's what I'm seeing a little bit of an uptick on is co-signing that for the first home, just to be able to even get a little more home for the money by just co-signing with a friend or a family member. All right, let's see what else we got. Any comments in the streams? This should be on Facebook and YouTube. So if you have any questions, love to answer them live for you here. So we'll kind of hang out and just see what kind of questions pop up. When should you consider making extra mortgage payments on your 30-year loan to pay it off faster? That's a good question. I see this one a lot because as people get ready to retire, or just to get rid of the interest, because even if the interest rate's 7%, 6.5%, which is high, if you will, any interest rate over 30 years is going to be a lot, especially the front end. The first 5 years is a lot of just interest, regardless of what interest rate it is. So people will see those numbers and say, hey, I want to start accelerating the mortgage. And really, especially if you have an interest rate, if you're a few years ago and you got an interest rate of 3 or 4%, why in the world are you paying extra money to pay that off versus taking that same extra money and bolstering your retirement accounts, putting more money in savings, get rid of any other debt that has any other interest rate outside of the mortgage. I think even David Ramsey is starting to dial back a little bit the idea of getting rid of the mortgage because it's debt servicing, the payment that can go towards that versus that same amount of money earning interest or upping your retirements or giving you a chance to build up not only your equity as the home appreciates, but the also your retirement accounts, your liquid assets. So I'm a big believer in that. I think there's a balance. If you have any other debt, tackle that first. Get rid of car loans, visas, student loans, whatever other debt. The money that you put towards that will typically go a lot further, a lot faster than it will be towards the mortgage. And then max out some of your retirements, max out some of those savings, then start looking at paying down the mortgage. Because if you have an extra $100,000 in the bank, how many mortgage payments could that make? Versus having 100,000 of equity you can't get to without selling or refinancing. So there's a balance. And I think that's an important part of my job is to review all the ways to use down payment, all the ways to be able to restructure other debt that can save money in ways that is more longevity, more liquidity, more access to the funds. And I said it, I'll say it again. Would you rather have $100,000 to help make the payment if things go wrong with your job or your income or anything like that? Or would you rather have 100,000 of equity? Now you can't qualify. You have to sell the home. You have to refinance, which is closing costs and points and title fees, all of those extra things. You might be better off just having a little more balance to have a little more of that money go on both places. So that's the way I look at things. Obviously, everybody's situation is going to be a little different. Their comfort level with that's going to be a little bit different. But I do really feel that you can't just look at just paying all that extra money to the mortgage. You have other debts, responsibility, liquidity. There's way more factors than just where should I put the extra money. And I'm generally going to lean towards don't put it towards the mortgage, put it towards savings, retirement, emergency, annuities, all kinds of different things. And I use this phrase all the time. Would you take $100,000 and put it in one gold bar or one stock? And most people say no. You want to diversify that. Yeah, you're going to take all that money, that extra money, and put it towards one house, one mortgage. There is better places to diversify that money. And so that's what I always like to sit down with my clients on. All right, let's go to the next one. Ooh, here's a common question. Boy, this is in, I bet you if I look at this every single day, there's probably this version of this question at least once or twice. Can I get a mortgage with a 550 credit score? Yes. You just don't want it. Yes, there's somebody out there that's going to loan to you regardless of your credit score, but your down payment's going to be a lot more. Your rate and terms are going to be a lot more. So working on the credit is well worth your time instead of always just trying to get whatever loan you can for that credit score. And generally, there's a reason why the score is that way. It can be medical. It can be divorce. It can be a lot of reasons why scores go bad. And a lot of times it can just be mismanagement, not knowing how it works, borrowing money and not paying it back, or being upset with your cell phone company because you turned the equipment back in, but there's some fee that you didn't want to pay because you turned it back in. I've heard every story in the book in 25 years. But generally speaking, managing the credit is going to be far better than just trying to get whatever loan will loan to a 550 credit score. And 620, so many things open up at 620. And it's not crazy hard to get to a 620 score. It does take some discipline, paying off some of the collections, get your bills back on time. It's going to take a little bit of time because it's amazing how quick you can trash your credit, but how long it takes to rebuild it. So short answer, yes, but work on the credit first. Try to get with me. I can review your credit for free. I can review all what's affecting your score, what's the best things to pay off, what are some tips to get your score to where you'll get better loans, better insurance, better everything. I mean, so many things are tied to this little 3-digit number that getting it better is only going to help your financial situation, period. And knowing why it is what it is, taking your head out of the sand on old collections, old charge-offs, whatever it might be, and just mature a little bit and get it done. Just get it done. It's what it's going to take. And it's going to have ripple effects for years to come, especially mortgages. The biggest debt you're going to have, having your credit score up is going to help in so many ways. But that version of that question I see all the time. Can I get a mortgage with bad credit, with this credit score, all that kind of stuff? And yeah, but let's work on the score. That's going to be just a way better way to do it. Let's see. I have a 30-year mortgage. How long does it take to pay off my mortgage loan if I pay 2 extra payments a year? This is known as biweekly payments. So because there's 52 weeks in the year, if you divide that out by 26, you end up paying 2 extra payments directly to principal. Now, the tricky part with that is biweeklies won't credit the first part of the payment typically until the second part comes. So the money sits there until the next wave of money gets there. So there is ways around that. There's different companies that will apply the payment, but generally speaking, the way it's built, the way that servicing is built, until the full payment's there, the first half just sits there. Plus, you want to start that half payment early before the first. That way, you don't pay your half payment on the first, your other half payment on the 14th, or wherever, however that falls on. So you don't end up having a late payment or something if that just falls off a little bit with the way the every 2 weeks work. So it's not the first and the 15th, it's every 2 weeks. And so there's going to be twice a year or even up to 4 times a year where you're going to have that extra half payment showing up, which eventually accumulates to one extra payment. So it can make a big difference, especially in the first couple of years. But again, that's where I look at saying, okay, where is that money better served? Is that extra 3,000, 6,000 with the 2 payments better served on paying down the mortgage or put into maxing out IRAs, 401s, Roths, those kind of things? And I think that there is a balance for sure. And I would say rounding up the payment to the nearest 100 or nearest 200 can be just as effective while still freeing up the money to go other places. So it's kind of back to the other conversation we were talking about with the idea, is it better to pay off the mortgage or something else? And that's where I lean a little bit more towards in savings and other things, paying off other debts. I mean, $3,000 extra, if that's the payment on any other debt's going to go way further than a mortgage, way further in almost every case. So why not chunk down that loan and not necessarily the mortgage loan, which has the best, easiest debt coverage ratio, usually the longest term fixed rate loan. So I think it's better off going other places. And maxing out the retirements, maxing out the savings, I think is really, really important. Let's go to comments. If you have a comment, you can post it there. You can check out ryanbolton.com. Got great mortgage calculators that are totally free on there. There's no login or sign in or sign up or paywall or anything like that, but they're really good calculators because they will factor in mortgage insurance, HOAs, taxes, insurance. So you're getting more of a complete payment and not just like the car loan payment. You know, it's going to include those other things that are typical with a mortgage. So you just get more of a complete picture of what the payment's going to be. I mean, if you had $250, $400 for an HOA, that dramatically changes that $2,000 payment you thought you were going to have. When you add the taxes, the insurance, the mortgage insurance, the HOA, all that could be $1,000 worth of other stuff that you want to make sure you have that factored. So having a free calculator is great. RyanBolt.com. There's no sign in, sign up. It's just right there on the website and very easy to be able to just run some calculations without any kind of trigger to do anything. Now, if you want to, obviously why I provide it for free is hoping you'll call me. I can go more specific on what you qualify for, which loan programs you qualify for, make any adjustments necessary, and give you more of a true quote. But it gets way closer. My mortgage calculator is going to be much, much closer than just other ones. And it is free. You don't sign up or download an app or anything like that. All right, let's look at some more questions. If you want to post a question, you can. How's everyone doing tonight? Can I afford? Let me grab my calculator. Let me grab the calculator here. Calculator question. I can't do it in my head. I mean, come on, who does that? I used to kind of be able to, but now I just given up. It's like, now I got a calculator. I want to make sure it's right. All right, so this guy says he makes $300,000 a year. So we divide that by 12. That's 25,000 divided by 45%. So that means the mortgage payment cannot be more than $10,250 with tax, insurance, all the other stuff out of there. Let's take a bunch of that out. But it looks like the answer would be yes. Let's see. Let's see. Quickest math you can do. Oh, actually, it does show wouldn't no. So it actually would show that he's trying to do $2.5 million on a $300,000 a year salary. It doesn't show that would be enough to qualify. So yeah, you'd have to make more than $300,000 to qualify for a $2.5 million home, and that doesn't count any other debts. You still have to factor in the other debts, the other loans. So there is a little bit going on. I actually thought it was going to be close, and it looks like it'd be about a $1.8 million loan, not 2.5. So it would be short at that salary. So he would need to make a little bit more. Now, sometimes the debt ratio will go a little higher, but it looks like he would be short even if it kind of maxed out. And it does depend on the value, the down payment, credit score. So there's other factors other than just what you make, but that's obviously one of the bigger ones. So that answer is no. All right. Hey, an easier one. Took longer to figure it out than what it was. Let's see. Can we use a portion of an insurance settlement to pay my mortgage? Yes. Yeah. The money to pay the mortgage can come from any verified seasoned source. So that's usually what's going to happen there is money laundering laws and banking laws require that we show where the money is coming from to finance the loan. Now, in this case, if she already has the mortgage and she just wants to pay it down, sure. Yeah, you can, just like you would any other, the money hits your checking account, you can bill pay or write a check or whatever you want to do to the mortgage and pay it down. Absolutely. But again, why would you take all that money and put it towards the mortgage where you might be better off taking that money and just put it in savings, emergency, use it to make the payment. So if let's just use the median income or median home price here in St. George. Let's say it's $580,000. She got an insurance claim for that, and now she can just pay the entire thing off. Well, how many months of payments can that $580,000 cover? Obviously, it depends on their interest rate, that type of thing. But generally, when I've run the math on that stuff, it's like 12 to 15 years that the payment is totally covered with that money you give them to today. Well, over that time, if that $580,000 was sitting in accounts, you could diversify. You could say, okay, I'm going to go 200,000, maybe a little more aggressive. I'm going to go 100,000, really non-aggressive to make the payment. I'm going to have another chunk in just annuities, insurance. That whole 580 could be diversified through who knows what kind of rate of returns you're going to get on it. And the mortgage payment is covered and it's more liquid. There's just way better places to put that than having the house free and clear. So now, great. Let's say she says, no, I don't want a payment. I don't want to deal with all this financial stuff, this mumbo jumbo. You're just trying to sell me on something. What would happen if you would then need the 580,000? Let's say health goes down, medical issues, one of the spouses pass away. Now all of a sudden you can't qualify for a loan. What if rates are higher? Now you got to get a loan that can cost you 10, 15 grand to pull the money back out that you need. Maybe now you can't qualify because income's changed, fixed income, spouses passed away, medical conditions, credit scores have gone down. There's so many other things that can happen. And now you have all this equity you can't even get to, where that 580,000 was in an account making the payment and you earning an interest rate to offset even some of the interest rate on the loan. Now, I've had people say, well, what if I can't get a 7% return on the money? Who cares? What if you get 2%? What if you get 2%? 580,000 of the 2% is going to extend out that loan of what you actually have to pay. You still got the tax benefits. You still have to factor in if you had to get to the money, the cost to get the money, now you don't have to incur. So it's not always about just matching the mortgage rate with the savings rates, but it's not crazy hard, diversified depending on risk tolerance, to get 5 to 8% on the money over the next 15 years, maybe even more. I got financial planners I can refer you to that they've shown different ways of annuities and different ways to diversify money that can get 8% or more. Now, obviously, I'm not a financial planner, so you want to consult your financial planner on that. But if you're looking for one, I've got some great referrals when it comes to financial planners. They can look at your situation and say, hey, here's some other ways that we can do this stuff. I'm live right now on a stream. You're messing up my stream. You're messing up my stream. Well, tell them to work on their thing. Yeah. I'm live on the stream. I'm live on Facebook and YouTube, and now my green screen effect is messed up. Hopefully everybody realizes this is a green screen. All right, no problem. We have our AC went out, so she was like, let me know the AC guy's here. Boy, having your AC go out in the summer sucks. All right. That's why it might be even a little glossy. I wonder if I can use special effects to get rid of the gloss. All right, let's see what else we got. All right. Let's see. Let's go to, maybe we'll go to another section here. Home buying. Let's see what's in this category. And again, if you're watching, you can post a question on there and I'll answer any questions about mortgage, about real estate credit, any of those types of things. Love to answer any questions you might have. This should be on Facebook and YouTube. I should be live on both, so we'll make sure that's working. All right, let's go to home buying. Let's see. What should I look for when choosing a mortgage lender for my first home? That's a great question. So there's a lot of different factors when it comes to who you should select. You can check their licensing. That's probably one of the first things I would say to do. Make sure they're licensed. Make sure they're not somebody that's not. I mean, that's pretty rare. I mean, most of the people have left the business. There's not a lot of people faking that they're in the business right now. So the people that are out there actually grinding right now are probably licensed, but double check that. There's an NMLS number, the National Mortgage Licensing System. You'll see it here on the bottom of my little banner here. That is the license number. You can double check that they're licensed. The shorter the number, the longer they've been in the business. That's one little trick you can do, because it's something that we had to get these numbers, and obviously the more people got in the number and the more requirements for the number just kind of keeps getting longer and longer. So it's pretty fun to see the shorter numbers of the guys that have been doing it as long as I have. They're kind of the 6 digits. And there's a expo that I go to in Vegas, and it's pretty funny where they'll say, okay, who has an 8-digit number, who has a 7, who has a 6, a 5, and a 4. Boy, those guys that have 4-digit NMLS numbers, they got the number of 4s even required. So it started kind of humming around that we're going to do this national system for mortgage lenders. And some of them were already getting into the system kind of early because they were licensed in multiple states. Boy, they were those guys that were 4s, man. It's funny watching all the hands kind of start to go down as 4, 5, 6. It's always fun to just see kind of the guys that have been around the longest. And a lot of times the MC guy, whoever's talking about it every year, will say, go shake their hand, go ask them what they've been doing. They could be a mentor, get their business card. I mean, it's just fun talking to those guys that have been just doing it forever. I started in 1999, but the licensing wasn't even really required nationwide like it is now, but there's still like a state license number. But then they switched that. So long story short, make sure they're licensed, double check their NMLS number. That'll really help to just make sure you're dealing with somebody that's experienced, and then check references. A lot of times the agents you're working for will refer you. The builder will have a lender, but still worth checking it out. Now, rates and terms, that's going to be the trickiest part, because we all get the money from the same sources. We're all using Fannie, Freddie guidelines, FHA, VA. We're checking rate sheets every single day. You're not going to see a huge difference in interest rates. You really just aren't. It's the service, answering the phone, email, experience, referrals, reviews, just like almost anything else, anything service-based. Because it's funny, we don't really shop around for like doctor stuff. We just go to kind of the doctor and just making sure that he's licensed and all that kind of stuff. But generally, mortgages, you're going to find experience level is going to be different, more so than rates. We really get the same. I get every rate sheet from every lender just about every single day. And it's all populated into our systems to be able to check every single day what rates are being offered out there. Now, there's niche products like non-QM. There's other ones that are going to have a little more difference in rates. But if it's Fannie, Freddie, FHA, VA, USDA, Utah Housing, they're all going to be very, very similar on any given day. And rates are just like stock prices, oil prices, commodity prices. Every single day, they are fluctuating. So one day you might get a quote that is different than the next day. Sometimes I ride that curve too, where, hey, we locked in, rates have gotten worse. Okay, we're safe. Go ahead and get quote all the day long. But other times you get people locked in, you hear news, the Fed, whatever lowers rate, you're like, oh boy, here we go. We're going to have to figure out that little tiny drop in interest rates. And I'll tell you what, the news is always a little behind on like average interest rates. I have people call me, oh, hey, interest rates went down today. I'm looking at my candlesticks and my little tracking. I'm like, no, last time they went down was like 3 days ago. And so part of my job is to track that, to try to time the market a little bit. But every single day it fluctuates. And so that's part of shopping more the person, the payment, the service, answering the phone, answering emails, having different products available. That's really going to differentiate way more than 6.375 to 6.5. It's just not going to change that much. All righty, let's go to little soapbox comments here. And if you have any questions, you can post it. Hopefully that's working. That should be turned up and working. All right. What are the real benefits of joining a large mortgage company with in-house underwriting versus a small broker? It depends. I mean, a smaller broker may not be able to generate enough revenue to have all the things in-house. But of course, in-house usually means some overhead that you've got to cover. You're going to have a lot more staffs you're going to have to cover. So I think that it's a benefit and disadvantage. But again, I think so much of it falls on the loan officer. The communication, the availability, the answering the phone calls, meeting deadlines, setting expectations, handling fires. I mean, that's much more what's going to separate than necessarily in-house underwriting versus a small broker. Now, I've worked for both, and there is benefits and disadvantages both ways, uh, but so much of it is based on the volume they're doing or the certain types of loans they're doing. That's going to separate it much more than whether it's in-house or not. Like even if you have an in-house underwriter, sometimes still loan files get sent off to a third party. So they're still going to have some brokering in some cases to handle all the different loans that are out there. Now, having some in-house is helpful if they're kind of nichey or there's certain programs they're doing a lot. And if you get big enough, then you can start getting delegated underwriting. There's definitely some benefits with the size, but there's also you lose kind of that touch with ownership or with the team a little bit. I mean, I've seen benefits and disadvantages both ways. And so I think so much more of it comes down to the individual loan officer trying to help you with your file. That's really where the buck stops. You usually will never meet the processor. The underwriter will never even know their name usually. You know, you don't even meet the appraiser most of the time. You're going to meet the title company at the very end. You don't even deal with them like we do or the real estate agent. You're going to have much more interaction with the agent and the loan officer than just about anybody else in the whole process. But there's a lot going on in the background. And that's part of being able to set up the right team that's been doing it for a while, that's experts in their area, that just know title companies and know what to look out for. And all that stuff is going to matter so much more. Let's see what else we got. You can comment if you'd like. Can independent mortgage brokers help with refinancing? Oh, I wonder where. Yeah, of course. Why would you think not? Huh, interesting. That's an interesting question. I never thought anybody would ask. Yeah, so mortgage lenders, we do refinance, second mortgages, first mortgages, reverse mortgages. I often tell people I sell money for a living. I know it sounds kind of funny, but if I were to cut it all down, I sell money to buy and refinance houses. That's my job, is to sell the money to buy and refinance houses. And having more tools, having more options, having more ways of getting that done is how I can say yes to more and more clients. And that's where being independent or a broker and not necessarily like a credit union or a bank gives me a lot more resources that I can tie into to have access to more products to help clients when they come in the door. So that's one of the reasons I've always been more of an independent or a mortgage banker and not necessarily a credit union or a bank, is not only the flexibility of the time. I'm able to kind of set my schedule a little bit differently than having to be at the branch or at the location every single day, that kind of thing. I can kind of set my schedule, but also the downside is I set my schedule to all the time. I'm never not working. My phone rings and an agent needs me. If a client needs me, my phone rings, I'm going to answer it night and day, weekends. I really try to make sure I'm really responsive to phone calls, because I know that's one of the things that can kind of help separate me from other lenders, is just answer the phone. It's like 80% of the job is answer the phone. So that's really what I try to pride myself. Am I able to do it all the time? Of course not. I got Zoom calls, I got trainings, I got all kinds of things, but boy, I really try to pride myself on either answering the phone or getting back really quickly. You'll even call me on my voicemail and say, I'll call you back within an hour. And that's because I really that's one thing I really, really work at. And because I think it's such an important part of the job, is just answer the phone. But yes, can independent mortgage brokers help with refinancing? Absolutely. What are the best ways to reduce debt when mortgage rates are expected to rise? Okay. So again, these questions can be vague sometimes. It's always interesting to get maybe one or two more words in there. What's the best way to reduce debt when mortgage rates are expected to rise? So either that's, if you already have your mortgage, you don't have to really worry about interest rates changing. But if you're trying to buy a house and you've got to kind of lower your debts to be able to then afford the home, because now the rates are higher and the home prices are higher, so it just gets more and more costly. The people that wait, I've talked to one guy probably 2 years now, and every single year it's gotten worse. And he keeps saying, well, I got to wait till the crash. I got to wait till I do this. I got to wait till I do that. And I get into a home. If you can do it, buy it. There's way more benefits than just the interest rate. There's the tax benefits of it. There's going to be the appreciation, the pride of home ownership, the tax benefits, the space. There's a lot of benefits to home ownership outside of just only financial. And I think on top of financial, it's a huge benefit, because if you're worried about the interest rate, what's your interest rate on your rental? What's your interest rate on losing out on the appreciation of any kind? What's your rate on not being able to have the space that you need? Or there's just a lot more things to consider than just the rate. But the short answer here is track your money. One of the training coaches that I'm a part of, he says all the time, if you don't track, you don't care. I love that. I've really tried to implement that a lot more. If you're not tracking where your money's going, you have no way of seeing what you can cut, where your money's actually going. And a lot of us don't. I mean, I'm amazed at how many people don't track where their money's going because either they don't care or they don't really want to know how much they're spending on Starbucks or Chick-fil-A or whatever it might be, or the subscription they're doing. When you start seeing it and you start tracking it, you will find places you can start cutting. You'll start recognizing, wow, look how much is going out on XYZ and how much you could cut that if you knew how much you were actually spending. So it's just like counting calories. It's like counting anything. If you track it, you will start to notice the numbers. And by having that power, the knowledge behind that, it'll help you to get rid of debt. It'll help you to realize the value of money. It'll get rid of the weird spending that society just wants you to do. And I've often said willpower is going to break down, but systems are what you need to work on. If you're just going to get out of debt or get in shape, all those kind of things, if you start tracking it and you start pumping into the system, it doesn't matter what willpower wants to do. You'll have those weapons to push back again because willpower is just going to give up. The psychology behind buying in America, the commercials, the ads, they're way better than your willpower. Way better. The psychology behind everything being a lifestyle choice. You'll have a better life if you buy this drink or this food or this better car, whatever it is. That's going to beat your willpower over time. It's just psychologically designed to do that. It's appealing to your flesh. It's appealing to your emotions. It's appealing to the temporary dopamine hit. But systems is the most important thing. So whenever it comes to buying a home, whenever it comes to debt management, start tracking it. Just start tracking. There's so many free apps out there. There's paid apps, of course. So it's funny that pay for an app to help you with your debt, but it's well worth it to know where your money's going. One of your biggest weapons against debt and all that is your income and where it's going. So track it. So that would be my answer for that one. Let's see if there's any questions. If you have any comments, questions, love to talk with you tonight. This is not my piano. This is a green screen. It's not my piano. I just, thought this is pretty cool. I mean, there's a little wave, but that's all right. All right, let's see what else we got here. Okay. Are you considering buying a home in the U.S. while mortgage rates remain stuck in a narrow range? Sure, yeah. Buy. If you can buy. Tell me a time, even from like 08 to 2010, one of the worst times in like housing crisis time, economic upheaval. Boy, that was a horrible 2 years out of how many years of home ownership, and even that recovered over time. Now, real estate's never been designed to be like a short-term quick thing. It's always designed to be a buy and hold. But you're going to have a housing expense either way. Why not own it? Why not have appreciation, tax benefits? Why not have your money going somewhere other than 100 I saw one thing was like 110%. By the time you lose the appreciation, the tax benefits, you're not just paying 100% interest to the landlord or to the property manager, whoever it is, but you're losing more than that because that not only is not going anywhere, but you're not getting any appreciation. You're not getting any other tax benefit. You're not getting those other things with it. Now, I understand buying a home is going to be more expensive than renting. That's been a big problem as home prices went up so quickly and then rates went on top of that. It's still cheaper to rent. People that have these mortgages of rental properties have these lower rates. They only owe $300,000 on a $600,000 home, so they can rent it for $2,000 a month and still make money. But you're already starting to see rents always go up. You never see rents go down. Mortgage payment is way more consistent. You have a 30-year fixed rate on the money. Typically, the only thing it changes is taxes and insurance, maybe the HOA if it has one. But even that's more predictable and a lot less than these rent increases you see all the time. And so even though everything's always going to go up, the costs are going to go up. That's just what it is. Value of currency, the way it's even designed, it's just going to lose value over time. But a mortgage is way more consistent than it is, especially with the other benefits of tax benefits, appreciation, the other things, than you will on any kind of rental property. So rental properties are great. There's a time and a place. I totally believe that. But don't wait. Just if you can buy. You can always refinance if rates get better, but you won't get the lower price. You won't get the appreciation if you wait 2 or 3 years or for some expected crash. And everybody's waiting for a crash is in the lower end. Well, if the lower end is the lower end because more buyers are always in there. you're not going to see crashes in the 500,000 and less. Maybe in the upper end, sure. When things are 8 million, 2 million, 3 million, those higher ends, the market of buyers is so much smaller. There definitely is more fluctuation in the upper end. But when you get close to that median home price for your area, that means there's way more inventory, way more buyers in that price range, way harder for those to crash. They're just way harder for it to crash because maybe if it does come down a little bit, now it opens the door for the people that were right at that tier. All of a sudden, your buyer pool increases even more, which makes it so it doesn't crash any further. It just has kind of this built in uncrashable sense. Even during the '08 crisis, it wasn't on homes under the median home price that you saw these big crashes because you could rent it, you could sell it for that. There's more buyers in that pool. So just if you can buy, get the process going, get pre-approved, find out where you're at, find out what the payment's going to be, and then go out there and wait for the house to hit the market or be more actively involved in trying to buy the house. All right, boy, we're getting on some topics today. If you have any questions, please comment down below. You can check out my website, ryanbolton.com. If you want to fill out the little sales funnel, it'll see if you're looking for a refi or a purchase, whatever you're looking for. And then you can just work your way kind of down that and I can call you. There's no cost or obligation, doesn't pull credit, none of that stuff. And then if you want to just call, my number's on there as well. There's also great free mortgage calculators. You don't have to sign up, download, give me your email, phone number, none of that. Just right free on the website. And they're some of the most accurate you're going to see because it does taxes, insurance, mortgage insurance, HOA, all that can be added. So you really get your true payment way closer than some of the other calculators I've used in the past. So I really like the company I use for my mortgage calculator. They're great. All right, let's go to how long have we been on here? I usually try to do about an hour or so. So we're getting close to an hour. If you have any questions, comments, concerns, throw them up in the comment box and I'll answer those for you. Let's go to why does it take over 30 years to pay off the mortgage when I sell my house? Why does it take over 30 years to pay off the mortgage when I sell my house? It doesn't. Boy, there's two things going on here that don't make sense. If you sell it, the mortgage goes with it, or just the mortgage is paid when you sell it. But there's no loans. There is 40-year loans, but they're pretty rare. I've even seen like 50-year, but it's amazing. I mean, a 30-year mortgage really is a magic number when it comes to the math because there is a big jump even from like a 20 to a 30 as far as the payment difference versus the savings in the monthly. But going from a 30 to a 40, even if it's million, I mean, it is such a small difference, but a huge chunk of straight interest for like 10 of those years. So they're not very popular and they really don't save that much versus the extra 10 years added to the loan. But why does it take over 30? It doesn't. I mean, unless you refinance and started the clock over again. I mean, there's a lot going on with that question, but no, it doesn't. All right. How are we doing here? Let's see. Let's see if I can find another category real quick with the last couple seconds. Again, if you have any questions, you can post them. Why should a first-time home buyer use a local mortgage loan officer? Well, they're more experienced, obviously. First-time home buyers are going to be new to this. That's why they're called first-time home buyers. And having a local mortgage lender will go and walk you through all the stuff of getting homeowners insurance quotes, the title company, the home inspection, the appraisal, all the things that happen that the loan officer kind of coordinates, along with making sure you're getting the best rates and terms based on your credit, your situation, that kind of thing. So I think it's really helpful to try to use local because it's just going to give you a local market. It's going to have you somebody that's face-to-face if you need it. You're going to have a chance to know what markets they're going to be living and working in the community. I've been here 20 years. I've seen this place grow like crazy in that time frame. And so I just have a feel for the market a little bit more than somebody that might be new or works nationwide. I mean, there's definitely some benefits of just having the experience. I mean, I can do Utah, Nevada, and Florida. And so it just gives me an opportunity to kind of tie into those different markets, be able to bring my experience level to those different markets. But I think local, it definitely helps. I think there's a big factor of me. I'll use somebody that's at least statewide, if not local. And there's lots of wonderful loan officers. I tell you, we've seen a shrinking in the number of loan officers during this whole interest rates have been up. I mean, when rates are 3 and 4%, you could license your dog and get a mortgage out of them. You know what I mean? But when it gets harder and there's just less buyers and you've got to be more career oriented, you've got to follow up better. You've just got to be more long term when things are this way. And we've just seen a lot of loan officers have left the business. So the ones that are local, that are grinding it out, that are still there day in and day out, those are the guys that that deserve your business as much as possible. So I would say stay local as much as you can, because we're all getting the money from local or from national sources, national guidelines, Wall Street, Fannie, Freddie, FHA, VA guidelines. All those are set. So having somebody local isn't going to hurt your ability to get better interest rates, because it's all kind of set by other metrics, by risk factors, by the property type, your credit, your debt ratio, your time on the job is going to affect your interest rate way more than who you're using in most cases. Now, obviously, there can be exceptions. There's still exceptions. There's going to be people that might be pushing different rates and terms and things like that. But generally, we're not compensated on anything but the loan amount. It's a percentage of the loan amount, regardless of the loan program. We can't make extra money. There's a couple reverse mortgages that are a little different, lines of credit a little different. But generally speaking, most first mortgages, it doesn't make a difference to the loan officer compensation wise on which loan to help you with. We just want to get you the best loans. There's no pushing you into, hey, I make more money if you do this loan than this one. It doesn't work that way in mortgages. They got rid of that with 08. There was a lot of steering that they were getting away from. And it's been that way for a generation now almost. So that is not something where we get any kind of compensation difference on an FHA versus a conventional loan, for instance. There's no difference there. So it is important to I think that's where using local is really, really beneficial. All right, we've got time for, maybe we can squeeze 2 more in. If you have any questions, please post, comment. Love to answer any questions you have. Let's see. Oh, here. Is it better to buy a home now or wait for live YouTube. Is it better to buy a home now or wait for property prices to drop? Buy now. That's the answer. Very rarely. I mean, 1.2% of the last 70 years, you could wait for a price drop. But 99% of the time, you're better off to buy now. You just are. Go talk to a real estate agent and look at the home you're looking at and look at the history of that home for the last 10 years. Did you see any price drops? Now, maybe micro, they listed it a little high and they dropped it. There's going to be that when they're listing it, maybe they're testing the market, what it's going to go for. But if you look at the history of that home price, it hasn't dropped. And most of the people that are asking this question are already in the lower price ranges, which there's more buyers. And if there's more buyers, there's more opportunity to sell that particular home. Now, we've seen people waiting a little bit. Yes, we're definitely seeing that trend because they're either waiting for rates to drop or this housing price crash. But if the prices drop at all, like everybody's hoping will happen, there'll be a run on those prices, just like we saw with the artificial price reductions or interest rate reductions that led to the whole COVID thing. Because all of a sudden now there was a limited number of inventory and a whole bunch of people flooding into the market. So if rates go from 6.5 to 5.5, what do you think is going to happen to home prices? Do you think they're going to go down? No. There's now a whole bunch more buyers that can qualify because now their payment's lower. That just floods the market with more buyers, and there's still the same number of homes that can't keep up as quickly as interest rates can change. So I'm telling you, buy the house. You can always refinance the rate if rates go down, but you're better off buying. You absolutely are. Are you going to wait another year? What are you hoping for? It's 5.5%, but now the price of the home's gone up $20,000, and you just spent $24,000 on rent. Buy now. Buy. I'm just telling you, you're going to be better off to buy in almost every case. Is there exceptions? Sure, but they're so small. I mean, this is something I can say with 95% certainty in almost every single market, you're better off to buy and hold. Even during the 08 thing, there was a rebound. Like any home that was built or bought in 08 that lost money during that time and they stayed out with it, their home is worth a lot more now, a lot more than it was if they would have sold it back or lost it or gave it up in 2020 or 2009. Which is one of the worst examples of the housing crisis. It took that much of a worse example for there to be a small window where it wasn't worth buying. But it's so small. So buy. Marry the property. Date the rate. I've heard that all the time. Marry the property. Find the property that fits, the payment that fits. It will only improve as time goes on. It will only improve as time goes on. Anyway, really appreciate you guys. Going to try to do this a little more consistently. I used to do this a lot and just got out of the habit of doing it. And I just enjoy talking about mortgages. So what a great way to just talk about mortgages, talk about credit, talk about real estate. So if you need help with a loan, I'd love to help you. Go to ryanbolton.com. I'm licensed in Utah, Nevada, and Florida. I'm working on getting some other licensing as well, but I've got a bunch on my team that can handle just about every state. So I'd love to help you with any kind of financing, but especially in Utah, Nevada, and Florida. That's where I'm licensed. I'm based in Southern Utah, just north of Las Vegas. So I handle that market a lot. I'm always up and down I-15. But I'd love to service your requests, just help you, give you pointers, point you in the right direction. Just love to help you with this real estate stuff. So until then, check out ryanbolton.com. We'll see you next time.